So I'll just very briefly go through some of the conventional critiques that people had as the euro was being formed. And we heard some of those this morning, so I won't major on those. I'll briefly go through lessons from the crisis, some of which we didn't mention this morning, and sort of emphasise the current impasse we seem to be with the euro. Then a relational perspective on finance and where that leads to in terms of how you would reform European financial systems and the euro institutions to try and make this work better. And I'll give you a bit of perspective on currency unions from it. These were just some of the conventional critiques. Just to note, this book is largely a collection of papers that Michael Schlitter and I wrote in the 90s and 2000s. We weren't allowed to put the paper we wrote on the euro in it from 1998, where we had a sort of Christian-based critique of the euro. So just to note that, some of us were saying these things 20 years ago, and it's not just I told you so sort of after the event. We actually said this wasn't a good idea before it happened. But yes, effectively euro members do not form what's called an optimal currency area. That is, they don't have enough commonality of their economic systems or growth models to it being worthwhile to have a single currency. The membership rules are actually misspecified. They focus on some of the wrong things. As we heard this morning, it doesn't include, for instance, private debt in the criteria. Those rules were broken by many countries. Very few of the EU countries actually passed the rules, but they were still allowed into the euro. The rules were not applied to France and Germany when they should have been fined in 2004 under the excessive deficit procedure, but because, of course, they colluded to say we won't fine each other or vote for fines for each other, they got away with not being fined. There's a sort of deflationary bias in the system that it penalises deficit countries, but it doesn't penalise surplus countries. It's actually quite difficult to see what Germany could do at the moment to get its trade surplus down. It could spend more governmentally, but do you say, you could say, right, German employers have got to raise wages by 20% to make us uncompetitive, to get our trade surplus down. So I have some sympathy with the German predicament, but they are locked into an undervalued exchange rate for Germany, and therefore gaining vast sort of savings abroad because of that process. And I would strongly argue from my finance ministry background, and as you know, finance ministries hate central banks and vice versa. I'd say that, and critics would say that the ECB, because it's meant to be a Bundesbank plus to get Germany to sign up, it is just super independent on its balance sheet and on its accountability to any sort of political authority. So, for instance, the ECB need not explain anything to anyone. I think it concedes that it will go once a year to the European Parliament to explain what it does. Sets its own target. It releases what data it likes. It doesn't have to do anything. Lessons from the euro crisis are that the real issue is that if you're moving to what is a sort of fiat currency system, so the euro is created by a central bank, it's not backed by gold or anything like that. It's a fiat currency system, but there's no bailout mechanism for countries in it. So the ECB is prohibited from bailing out countries directly under the treaty. Fiat currencies only really survive if single state, single government, tax-raising authority, a single central bank, and the central bank can effectively without that, then what would have been currency risk, currency falls because the government's weak or the economy is falling, gets translated into government credit risk. So what you saw from the charts this morning of different countries' 10-year government bond yields rising during the crisis, what would have happened before the euro was that the currencies would have fallen. The lira, the Greek drachma, and so on would have fallen to reflect the weakness of their economies or their fiscal position. Instead, because the currencies are fixed, what falls is government bond prices, and the yields on those bonds go up to reflect the risk of default. And so you don't get rid of risk in a currency union, it just changes from currency risk into sovereign credit risk. Now then, the problem is that in a single country, a single tax-raising authority, if the country's cost of borrowing goes up, the cost of everything else in that economy goes up. Because it's thought that the government, the tax-raising authority, is the safest borrower. So if the Portuguese government's bond yield has gone to 8%, a Portuguese corporate is only going to borrow at 10%. So once you move currency risk into sovereign credit risk, then that leads to higher costs of capital for everything in that society. And the real problem is this point at the end, that means the banks are hit because the sovereign is in trouble. Because as I can go into detail, and as the bankers in the room will be happy to tell you, banks only exist in their current form, highly leveraged, undercapitalized entities, because of implicit insurance from either the taxpayer or the central bank that in a crisis they're going to be liquefied or bailed out. So if the country gets in trouble, then the banking system gets in real trouble of that economy. Now, the problem for Europe is that its banks are enormous relative to the size of the economy. In the US, the vast majority of credit gets channeled through bond markets. So it's roughly, rule of thumb, 80% of new credit is originated and goes through bond markets, 20% stays on bank balance sheets. In Europe, it's the other way around. Roughly 80% stays on bank balance sheets, 20% goes through bond markets. Therefore, the euro area economy is vastly dependent on the health of its banking system in a way that the US and to some degree the UK is not, because we channel much more credit through markets. And so therefore this link, sovereigns to banks, means that when sovereigns get in trouble, banks are in deep, deep trouble. And the problem is that Europe had a number of large international banks that dwarfed the ability of their taxpayers to bail them out. Not just in Europe, Switzerland had two enormous banks that got in trouble, and the Swiss taxpayer could never have bailed them out. But there are large banks in Germany, France, Spain, Italy, that have big international sort of operations. Just as an anecdote, the bank that became the largest in the world in 2006 and made every mistake conceivable for a bank to make was, of course, British. But so this isn't just a euro area problem, it was a problem for many Western countries. But it's a particular problem for the euro area because US, UK, Switzerland, Japan have big banks, but they can print their own currency. There's no clear bailout mechanism for the sovereign and the banking system in a particular euro area country. That's why this is a particular problem for the euro area. There's no credible banking lender of last resort. also seen the euro system does facilitate capital flight from weak to strong economies because of this currency link is unbreakable, but the strength or weakness of banks in countries changes and differs. So even though you've got euros in a Cypriot bank deposit, if trust is lost in a Cypriot bank, they're not worth the same as the same deposit in a German bank. So in crisis, capital flows from those banks, those countries where the sovereign is thought to be weak, to those where it's thought to be much more credible. So as we saw this morning, this is just the target two imbalances that are rising. Should I try and get some light down?
Well, there is some big
dim,
light over there. That's not
some of the curtains. So as those who weren't here this morning, these are just the accumulating debits and credits within the euro payment system that it channels through the ECB's balance sheet in something called a target 2 payment system. And so it's just a neat way of showing how much capital is flowing via the ECB's payment system from Italy and Spain, the red and the green at the bottom, to the Netherlands and Germany and Luxembourg at the top. So it's now up to €1 trillion into the German banking system, essentially from Spain and Italy. I'll come on to that in a minute. So you've got capital flight being facilitated because of this price fixity on the exchange rate. What would have happened before the euro would have been that the currency would have weakened. Therefore, yes, capital then flows into a weak country because the currency starts looking cheap and assets in that country start looking cheap. So there's a price mechanism, there's nominal price flexibility that normalizes this capital flight. In the euro, there's no price mechanism to stop this happening. So it will carry on building up. If Italy or Spain is seen as weak relative to Germany, this will continue. And there's no reason for it to stop until you get a turnaround in the Italian growth prospects relative to Germany. And in one sense, if the euro holds, it doesn't matter. This only matters if a country leaves or is forced down. What we've also learned is that member state governments can be undermined or removed through threats by the ECB. So the key point here is that European banks have to or seek liquidity, short-term liquidity from the ECB. They can decide what collateral they take to lend to the banks. They have to post securities to the ECB. Banks tend to own their own government's debt. Greek banks tend to own Greek government bonds. Italian banks own a lot of Italian government debt for various historical and financial reasons. And so, if the ECB says to a government, I don't like your credit risk on your bonds, I'm not going to take your bonds as collateral, then that banking system is illiquid, because it's got no collateral to post to the ECB. And so this can be used as a threat by the central bank to bring to heel any government that it doesn't like in terms of its fiscal policy. So as we've seen in 2010 in Greece and 2012 in Italy, effectively the ECB and Germany removed elected governments because they were threatening to do things, either leave the euro or do something more radical on fiscal policy that the centre didn't like. And so this is the chain that you yank to bring to heel an elected government doing things you don't like. There is now vast concentration of power by the ECB. So it's not just ability to do this through what collateral it takes to threaten the collapse of a banking system, but it now has banking supervision responsibilities for the systemic banks in the euro area. It doesn't, there is no cast iron treaty basis for it to do that legally. There is one clause in Maastricht that was put in just as a Hail Mary, just in case type clause, just in case the ECB ever had to do something in a dire emergency. But it's now built effectively a single banking regulator on the basis of a very tenuous legal basis. And it has but because the ECB is super independent, it doesn't have to tell anyone what it's doing on banking supervision. So if we had a systemic bank go down in Europe, in the euro area, and the ECB's made a mistake and missupervised it, it doesn't have to tell anyone why and what mistakes it made. It's got an implicit conflict of interest because it is acting as a counterpart in the market to the banks it's supervising. So if it makes a mistake on supervision, it can covertly bail out that bank to cover up its own mistake. No one need know about it because there's no oversight, there's no information, there's no transparency. It can choose to say things to the European Parliament, but it doesn't have to. But of course, what happens when it allows a systemic Finnish bank, to go down, but rescues a French bank? Because it thinks a French bank is more important than a Finnish bank. That will happen one day. Supervisors make mistakes. Then we're into just what we've learnt is that Euro exit might be economically sensible, but it's technically effectively impossible. I was talking to Esa yesterday. It's not impossible in terms of redenominating debt contracts. So you might think, oh, you can't leave because my government will then be indebted in euros, and it's raising taxes in new marker, and there's no point in leaving. That's not true because so long as your government has issued debt under its own law, it could change the currency in which its debt is denominated. So that's not the problem. The real problem is that you won't have an electronic payments mechanism denominated in your new currency for a minimum of a year. Because you can't make these preparations in secret. You can't print new marker on the quiet without it getting out. You can't form a payment system to deal in new marker on the quiet and have it there ready for when you leave the euro. So you're therefore faced with a sort of payments system problem for a year, 2 years, a reversion to a cash economy, a reversion to writing a check. People would start circulating their own monies, and there would be private credit alternatives for a while before that got going. This is why Greece has not left. It cannot technically make this preparation. This is why when Italy started talking about a parallel currency last year, that's when it gets interesting, because that's a first step to exit, because it's going to start getting the systems ready for a new lira. But it's going to operate in parallel to the euro. So that's sort of halfway house you've got to start thinking about before you take the plunge. But this is technically very difficult. Just to note, this is just to highlight that with the ECB's decision to start quantitative easing, that is buying government bonds to get interest rates down, it has facilitated capital flight from Italy. So the ECB's, this is the cumulative purchases of Italian government bonds since the ECB started QE in 2015. The only buyer of Italian debt over the last 3 years has been the ECB. So it has essentially financed all Italian deficits over the last 3 years. Everyone else just about has been a seller, overseas, domestic Italians, and so on. Right, so we're now in this sort of impasse. The euro, ironically, has not resulted in convergence of the member economies. Obviously, you've seen big divergences in productivity, unit labour costs, and so on. It's ironically not increased intra-block trade more than the rest of the world economy. So the whole point of the euro was fixed exchange rates will force conversion through common economic policies, and then we'll trade a lot more. That was the point. It hasn't done it. The rest of the world has actually done more of those things without currency fixity. So ironically, Australia and New Zealand have two different currencies, but they've done more on convergence and intra-block trade than the EU. You don't need a fixed currency to do these things. However, it has facilitated, as we saw, high, big asset bubbles in housing in particular, in what were high inflation member states, in Ireland, Spain in particular. Problem is that the ECB is vulnerable, the euro is vulnerable to the next global recession because we're going to need seriously negative interest rates. Because if you think global economy is sort of weakening quite rapidly now, the ECB is sort of maxed out on stimulus, sort of interest rates at -0.4. It's just bought 2.5 trillion of debt. But this is the good times. So we've got more stimulus to go. It hasn't got interest rates to cut unless you go seriously negative. And it's bought sort of a quarter of the government bond market. So it's going to have to start buying more and more assets and taking interest rates more and more negative if we face another recession. However, its weakness is that it cannot legally finance governments directly. Bank of Japan, US Federal Reserve, and soon the UK. This is one of the reasons for Brexit that nobody talks about. One of the reasons for Brexit is that if the Bank of England has to directly finance government deficits, it will be able to do so if we leave. We cannot currently do that under the treaty. Currently, euro area government finances are held together by the ECB's sort of promise of what's called OMT, outright monetary transactions. This was the whatever it takes gesture that Draghi made in 2012 and just held everything together. The ECB has never actually performed one of these operations and has not said how it would do so, how it would go in and buy just Italian government bonds. However, to fix the euro, to get rid of many of these weaknesses, you've really got to move to big centralisation of what's not there at the moment, which is in particular a risk-free asset, a government-backed asset. So you need a single borrowing authority to issue jointly guaranteed bonds. That means you need a euro area tax instrument to back that. It means you need harmonised backed bank deposit insurance, because at the moment each country has its own system and there's not a mutual guarantee. So effectively each sovereign backs their own deposit insurance scheme, because Northern Europe, you don't want to be on the hook for the Italian banking system. get rid of that sovereign bank problem, you've got to have that. And then, of course, you want the central budget big enough to be able to do counter-cyclical sort of stimulus measures. So this means, to do this properly, you've got to have a tax base that is 10 to 15% of GDP minimum. From nothing at now. So effectively, a third of your tax receipts have to go to a euro area common pool for counter-cyclical fiscal stimulus to be feasible. Now all this is continually proposed by the Commission and the ECB and ignored by member states because they know that it's not going to fly. But you do need to do this from a sort of standard conventional macro perspective. To fix the euro, you've got to do that. So we've got this problem. The euro can't break up. Some people, we've heard how it might, but it's a terrible crisis if it does. But it can't move forward. It's sort of like the mountaineer halfway up the mountain. There's been an avalanche below, we can't go back, but we've realised we can't go up because the mountain above us is too treacherous, so we're stuck. What do we do? So, just to give you a bit of background on the sort of relational approach to finance, this is again sort of derived from biblical thinking, and it leads you to some sort of ideas to get you out of this trouble. You have to think that money and finance is not an objective thing, an autonomous thing itself, but always a tool of expressing relationship. The Bible says that debt is actually equivalent to slavery or servitude, not because you've been forced into it necessarily, but because you've made a promise to repay, and therefore you're no longer completely free. You've bound your hands. In English, we'd say you've given your bond to repay, therefore you are in bondage. The Bible emphasizes the blessedness of interest-free loans because relationship is more important than financial return. But it also then points you towards emphasis on using alternative contracts to intermediate finance, particularly equity and rental or rent share, because a debt is financially rigid. It's got fixed payments in the future. They're not linked to the productivity of the activity being financed necessarily. Whereas equity is much more flexible in terms of the returns are linked more closely to the profit of what is being invested in, or the losses. So if there are losses, financier loses money. Similarly, rental of real assets is a way of linking ownership use to payments for it. So from that perspective, what then you start thinking about? And these are some of the issues, some of the ideas that I mentioned beforehand, but particularly you start thinking about what are the sort of more price-flexible contracts do you use to substitute for currency risk. So if you remember, fiat currencies survive because the exchange rate goes up and down, and it's the safety valve of the system. Without that, you need other prices to move, but they're very reluctant to do so. So what would normally have happened would be if the currency is fixed and productivity falls dramatically, then wages and prices in that country should be falling. The problem is that traditionally populations do not like the idea of wages falling in nominal terms. That's partly because their debts also fixed. And so if your wages fall, I can't pay my mortgage, or I can't pay my credit card, because I can't, they're not falling. So part of the problem with fixed exchange rates is that if your population is indebted, they can't live with falling wages. So if wages won't fall, what other mechanisms have you got to bring in price flexibility? So one of the things you can think about is on sovereign bailout questions, so particularly with Greece. At the moment, we've got Greece now in a 2-generation debt prison. There is no way Greece is going to pay off its debt in any time soon. There is no way that people from outside will invest in Greece whilst its debt is so large, because there's always the risk that if something prospers in Greece, it's going to get taxed very heavily in order to pay that debt. So there's no incentive for outsiders to come in and invest and make Greece prosper and buy Greek assets. So what you do need to do from a relational perspective is fix the relationship. So if countries do not regard each other as brothers and sisters, brethren, they shouldn't be in a single currency, period. But once you're in, but you don't feel that brotherly or neighbourly, what you do is try and realign incentives. So the Greek liabilities shouldn't be a fixed debt in euros. They should be linked to GDP of Greece, so that if Greece prospers, it does pay back. If Greece does not prosper, those who financed it should take losses. That realigns incentives so that northern countries start thinking, right, I need to encourage or help Greece to prosper in order to get paid back. These exist. They were an element in the second Greek bailout. So there is a Greek GDP-linked security, pricing and trading in the market, not very liquid. But it should be on an intergovernment basis. This is how you should do bailouts, not debts. I float the idea of a legal mechanism in the treaty for Euro exit. That's a big question mark, however, because as soon as if all the countries in the area agreed that there needed to be an exit mechanism to avoid a crisis of a disorderly exit, as soon as you introduce that, then those countries who are thought to be most likely to leave will face a much bigger borrowing cost. So as soon as you do that, Portugal's cost of borrowing will double. Italy will be borrowing at 6 or 7%, not 3%. So just introducing that leads to market discipline on government finances, but you've got to be prepared for the consequences. A sort of more radical approach, however, is to take that idea of relational finance, debt not being a good idea, and start applying it more radically across economies and financial systems. We've talked about much more fiscal transparency intergenerationally to really show the current generation how loose fiscal policy is if you're looking at it on a 2-generational basis. So, for instance, the UK currently, we've just got our deficit down to about 1% of GDP. If you were doing it on an intergenerationally fair basis, we should be funding all our pension promises we're currently making, and we should be running a surplus of about 6 or 7% of GDP. So with the promises we're currently writing to future pensioners. So we are currently about 8% too loose fiscally. However, we think we've been really good to get our deficit down to 1% of GDP. We haven't really started on this yet. What you do need to do, however, is across Europe, only a couple of countries have tried, Germany and Belgium, have tried to eliminate some of the tax incentives to debt. UK has talked about it, but not really taken any measures. But essentially, because we give corporates, we allow them to deduct debt interest from profit before tax, but not dividends, then we give them an inherent incentive to leverage up. And we give the private equity industry effectively a big incentive to take companies private, buy out their shares, indebt them, sell them off, and let them go bankrupt in 2 or 3 years' time. Because all they're doing is just taking this tax break and giving it to themselves from the taxpayer, and then letting companies get much more risky as they're floated off. We need to, I would argue, reverse that. We ought to be tax advantaging equity, not just going to neutral. This applies to banks as well, of course, because banks are debt financed balance sheets. They get this subsidy. So ironically, one of the solutions to the crisis was to introduce contingent capital instruments for banks. These are sort of quasi debt equity instruments that in a crisis become equity. None of those were issued until governments gave them this tax break. So we treat them as debt for tax, even though we treat them as equity for regulatory purposes. For the bankers in the room, I'm sorry about this, but banks as an industry enjoy vast subsidies from taxpayers, not just in Finland, but everywhere. So the Bank of England calculated that the 29 largest global banks receive a subsidy of $180 billion a year from governments. That comes about through being given deposit insurance that isn't charged for, through having a central bank that will give you liquidity insurance without paying for it, and so on. And so we give vast incentives for banks to get big relative to the alternatives of how you do finance. And now we're left with banks that are too big to fail. We have banks that are too big to jail. So US Department of Justice has admitted that it couldn't seriously prosecute HSBC for money laundering with Mexican drug cartels, because if HSBC fails, the world economy is seriously in trouble. So we need to get banks much smaller so that they can be allowed to go bust. This is the big problem for market systems. This is how you're going to get neo-communist socialism in countries, the next financial crisis, because we'll be fed up with bailing out for-profit financial institutions that then want taxpayers to cover their losses. So unless we address this, the next crisis leads to bank nationalisation, politically driven allocation of credit, and huge taxpayer losses. We've got to get that sorted. And then this is the sort of really radical structural question, is across Europe, across the world, we finance housing through debt in the main, rather than equity instruments. It's a perfectly feasible instrument you can think about, where you share the rents on a house, not require interest to be paid on a debt. So I'm co-financing a house at the moment where I share the rent on it, rather than taking out a debt and paying interest. And so I'm sharing equity in a house and sharing the rent in it, not having a mortgage on it. If you did that, you would fix a big hole in our financial systems. Currently, we don't have a savings instrument that gives you house price returns, housing returns. And it makes your whole housing market much more stable. Because once you debt finance something, equity finance something, there's a lot more price flexibility and cushions in the process. So that idea flows from this point about move to less debt, less leverage in the system. What are the objectives of that? It's effectively to try and bring in price flexibility where we haven't got it at the moment in the financial system, in housing and so on, to substitute for currency flexibility that we've given up by being Euro members. Part of it is to reduce overall debt levels, partly to allow wages and prices more flexibility. So if you just think, effectively the euro is a bit like a gold standard. You've got a non-backed currency, but it's rigid. It failed in the 1930s. Countries left the gold standard because their debts would have been defaulted on if they didn't. They had to inflate to get rid of their debts. At the moment, barring crisis and breakup, you can't get out of that euro, you can't get out of the fixity. So how do you introduce more flexibility? Well, get debts down across your society so that you can allow more wage and price flexibility downwards. Just think, for 300 years, the UK had price stability over sort of the long term when we were on the gold standard. Since then, our price level has risen 100 times. So what a pound buys now, a penny bought 300 years ago. Why? Because we can't allow prices to fall because of our debts would become unpayable. So ultimately the objective is, how do you make the financial system viable, flexible, without needing those federal superstate fixes that the Commission and the ECB think are needed to keep it going. So that's just some quite radical financial ideas to do it. I won't say that these are easy fixes, these are radical changes to how you do finance. I wouldn't say that they will definitely mean that the euro could be solved, and you might argue that euro exit breakup